What's up, fam? Back at it again with another episode of Blank with Mike. I'm your host, Mike, obviously. Now, this episode is going to talk about the 5 main strategies that are used within the stock market. It's going to be my perception of it, my opinion, and I'm going to go through casually what they all mean. So sit back and let's enjoy this video. Okay, so you're interested in the stock market. You've got your broker set up, and you want to figure out your way of navigating everything, right? Well, there are generally about 5 different strategies that I've found. There's a few more. There's a strategy I'm personally using that I can't find as a name for. I call it Mike's strategy. Sue me if I'm wrong. So, let's go over the first strategy. It's what's pretty much known as growth stocks. Now, these stocks are fairly mature. They've been around for a while. They need more investment to throw back into their company to make that company the next better version of that company, so to say. Now, what's interesting about growth stocks is they are profitable for the most part. Some are not, some are. It just depends. But they don't give out dividends. Now, I myself, I love dividends. Gimme all the dividends, baby. That's me personally. I don't dabble too much into growth stocks. I do have one. And I have another one I'm kind of keeping an eye on and seeing how the new political leadership plays out for that one. But these companies, they pretty much take your investment, your money, and they reinvest to build the company up. Make it 2.0, for example. A really good company to consider as a growth company would be Amazon, believe it or not. They don't pay out dividends, unfortunately, but they are growing. Now, keep that in mind. Amazon's been around for quite some time. 10 years ago, they were here. They're not nearly as big as they were now back then, but again, the money they're making, their investment money, they're putting it back into the company and making it bigger, focusing on different aspects within the company to make it that much bigger and better. Now, their stock prices, they will go up, they will go down. Any stock will for that point. It's just part of how it goes. But there are, now I'm not saying these companies are bad. Like Amazon, I love and hate Amazon. You can see in the background right there, I got an Amazon box with some Christmas gifts for my loved ones. I personally don't like growth stocks. In particular, these don't pay dividends. That's not something for me personally. So I tend to stay away from growth stocks, just me. That's my strategy, my way of looking at it. If you like growth stocks, by all means, buy them left and right. Have fun. Let me know how it goes. It's just, I personally don't like growth stocks. What I do like are dividend stocks. Another strategy. Now, on my previous video, dividends. Now, with dividends, I like the fact that they've pretty much gone through their growing pains. They're a stable company, they're profitable, they're making some money, they're rewarding their shareholders, in quarterly, monthly, year, and 2 times a year. So it's really, I like these companies because it will generate a really unique and beautiful system called the compound interest. More on that in another video because that deserves a whole video of its own. But I personally love dividend companies. My portfolio I have a lot. I need to clean up some of them because I kind of went a little too far in certain sectors. Need to pull back and clean it up a little. That's just me personally. Now there are downsides and there are upsides for dividend stocks. The downside, unfortunately, is the company can just stop that dividend The upside is making, continuous payments to the shareholders and making money as well and all that good stuff. Another strategy is searching out for IPOs, initial public offerings. These are companies that are private, that are now going to be traded on the stock market. People will really look and pay attention to the companies that are making it happen, hitting headways left and right, and when they hit that IPO status, they buy hard into it. They buy heavy. They buy every single share they get their hand on. And then in turn they sell once the IPO starts like $10, skyrockets up to like $1,000, and they just sell them off. I agree with that strategy. It does have potential to make you a lot of good money, but I personally don't like it for me, my personal state, because it requires a level of risk. Risk I don't feel comfortable with, because sure, IPO started at $10, sell for $50, boom, I could sell it, but when did it hit that $50? Tomorrow? Next week? Next year? Am I available to operate my broker on my phone or my computer where I can sell it at that $50 mark? Or am I going to lose it and when I get home it's at $20? So I really don't personally care for IPOs. But there is one that I'm looking forward to. It's called Dash, or DoorDash. I'm really looking forward to that one because I want to put some money in. I want to buy that IPO because I have a gut, sincere feeling that DoorDash is going to be a major player in years to come, especially what's going on right now, the pandemic, right? If we go through a lockdown number 2, especially in the U.S., well, you're still going to want some food, right? I mean, let's face it. Kind of on the fence with other IPOs. I don't really care for IPOs. They just don't really play well with my risk tolerance. If that's something that interests you, by all means, more power to you. Me personally, I'm good. Now the fourth one, it's labeled as defensive stocks. These are stocks that are gonna do well whether the economy's in a recession, uphill climb, whatever. These companies are gonna pretty much be on track to do good. They're gonna float up a little, they're gonna come down a little, but they're gonna pretty much hit that medium mark good. Mainly in the consumer staples market, companies like Campbell's Soup, believe it or not, they are a dividend company, so I own a couple shares of them, one share. But these companies, they're really good companies. They really hold their value, so to say. And that no matter what the economy is doing, they're going to be there. They're going to maintain, that, not like way up here on IPOs and growth. They're just going to be like, we'll go like this, up and down a little bit, not in comparison to other stocks. But I personally do like this strategy. I intertwine it with my dividend strategy because, again, I look for dividend companies. I don't care what kind of company it is, I look for the dividend. Then I go into more research and I figure, okay, I like this company. No, I hate that company. It just kind of plays in what my strategy is. It's just how I look into it. The last strategy that I've came across is worded differently than all the articles I've read. The general consensus of it is pretty much how you would normally think of the stock market. Buy low, sell high. It kind of intertwines with growth stocks, but I personally don't like that. I'm a long-term investor. I don't care if the price is right when I buy. I'm going to hold that bad boy for 10, 20, 30, 50 years. However long it takes, I'm going to hold that. That's mine now. So I'm not really in the market to sell these stocks. I have bought low and sold high when I first started. Not comfortable with it because I didn't really understand it, do any research, didn't do anything. I just saw it for cheap, bought it, and then saw it for going up this high, sold it, got the difference. So that's just how I look at it. Now, there are other strategies out there. These are the main 5 that I've figured out. They parallel to other research papers I looked into. Look at my strategy. What I do first, I think of a company that I normally use. For example, Dr. Pepper. No, you're bringing it in, right? Alright. Well, they are a publicly traded company. Excuse me. I love Dr. Pepper. Yummy, yummy. They are also merged with Keurig. So they have their own stock, Keurig Dr. Pepper. Now, I looked into it. I obviously use Dr. Pepper. So I looked into it. I found they paid dividend. Boom! Caught my interest right there. Got 2 strikes right going good right there. I did the research. I looked at their books. Looked at their quarterly reports, their yearly reports. I did everything I could to find out if this company was worth my money. Okay. And I found it was at that time. So I bought a share. Okay, it's right there, it's sitting pretty. I want to dig deeper and further into it before I buy more shares. But I like it, it's mine. So I look at it. That's my strategy. Now, it does intertwine with all the other strategies I mentioned ahead of time, but it's just my unique way of looking at it because I'll give you another example. GoPro. I bought this company. I bought 1 share of it. Now, excuse me, I had 4 shares of it when I first initially started trading. I looked into the company, saw it didn't give dividends. So I went, okay, it's a growth stock. I'll be alright. Looked more into it, did not like the results, sold it. Now I could have sold it for a loss, but I sold it with a 1 penny gain. Okay, I want to make some money. I had 4 shares, I made 4 cents. Money, right? It's money. Not like $1 million to go buy myself a Ferrari, but I made 4 cents, so I made some money. Now I don't consider that a mistake, but I do consider that a learning lesson. Because that's what got me really looking into strategies that fit me. Okay, strategies are based on what you're wanting to do. In my videos, just my journey. None of this is financial advice. I am not licensed, certified, anything in the financial market or any nonsense of that. It's just my journey. Telling you what I'm doing. Now bring you along with me because I want to share my journey with you. I want to look back in the years in the future, look back in these like, wow, Mike, good move, or wow, Mike, you made a mistake, but you know, it's just how I'm looking into it. So that's what the strategies I've found in my little research. Down in the description, there's going to be links to Webull and Robinhood. Deposit $100 into Webull, you get 4 free stocks. Now, you don't have to keep that $100 in there. You just get 4 free stocks. Wait about a month, give or take. Take that $100 out. Keep your stocks. Free money. And Robinhood, you do have to deposit a little bit. I don't know the exact amount. It could be anywhere from $1 to $20. But again, same thing. Deposit it in there. Wait for your free stock. Take that money out. Simple as that. Also, my Instagram is down there. I'd love to see you guys on Instagram. I'm going to post some pictures on there of my portfolio and show you some stocks that I own. So, hope to see you in that one, alright? You guys take care now. Bye!